Okay, picture this. It's April 2025. The markets are just humming along, everything seems fine. And then, bam, in a single day, everything changes. A political announcement triggers what feels like a financial earthquake, sending these massive shockwaves across the entire global economy. So let's dive right into this hypothetical crisis and see what it tells us about the market's absolute biggest fears.
No one can escape. This was the feeling on the trading floors on April 3rd. Not just, caution or a strategic shift, but pure raw panic. It was this feeling that no matter where you were invested, stocks, crypto, you name it, you were completely caught in a storm. So just how bad was the immediate damage?
$2 trillion. That is the staggering amount of value that was just erased from the S&P 500's market cap in a single day. To put that into perspective for you, that's more than the entire annual GDP of a country like Canada or Brazil. Just gone. In a flash. So what on earth could cause a market reaction this severe? Well, the answer comes down to a single policy announcement that basically threatened to tear up the rulebook on global trade overnight. And it happened so fast. On April 2nd, the administration unveils its reciprocal tariff policy. First, a blanket 10% tariff on almost every single import. But wait, there's more. They tacked on massive additional penalties for key trading partners, a whopping 34% on China, 20% on the UE, and 24% on Japan. The response? It was immediate. Just 2 days later, China fires back with a mere 34% tariff on all U.S. goods. All of a sudden, this wasn't just a policy. This was what the source material is calling a de facto trade war. So, with those battle lines drawn, global financial markets just went into a complete and total tailspin. The sell-off was broad, it was brutal, and it was immediate. You can just see the carnage right here in the US. The tech-heavy NASDAQ got hit the hardest, plunging nearly 6%. The S&P 500 had its worst day since the COVID crash back in 2020. I mean, these weren't just little corrections. These were historic, panic-driven drops right across the board. And this just triggered a massive rotation of capital. Money was fleeing from any company that was deeply tangled up in global supply chains. Tech giants like Apple, consumer brands like Nike, the entire semiconductor sector, they all got absolutely hammered. So where did all that money go? Straight into the traditional safe havens. We're talking defensive stocks, government bonds, gold, and the Japanese yen. It was a classic textbook flight to safety. So what about crypto? The so-called digital gold? Well, it didn't act like gold at all. Not even close. Bitcoin dropped over 5%, and the major altcoins, they fell even harder. This moment really proved that when a true risk-off event hits the fan, the broadened market still treats crypto just like any other high-risk tech asset. It's not a safe haven alternative, at least not yet. Okay, so with all the damage assessed, everyone's attention immediately turned to the future. This shock created massive, massive uncertainty. And according to our source material, the market was now staring down 3 very different potential paths forward. This was the one question on every single investor's mind. Was this just a painful but quick correction, maybe a buying opportunity? Or was this the opening act of a really long bear market and maybe even a global recession? Let's take a look at the scenarios. The analysis breaks it down like this. First, you've got the optimistic scenario. This is where cooler heads prevail, negotiations actually work, and we see a rapid market rebound in just 2 to 3 months, kind of like what happened in 2019. Then there's the medium, or base case scenario. Here, the friction continues, but policymakers step in with support. The market bottoms out in maybe 3 to 6 months, and then we get a gradual recovery, a lot like the 2018 trade war. And then there's the pessimistic path. An escalating trade war, a global recession, and a long-term bear market. The parallel here is a terrifying one. The 1930s Great Depression, right after the Smoot-Hawley tariffs. Okay, so you're facing these 3 potential futures. What do you do? How should an experienced investor react? Well, the source provides a really clear, actionable playbook for navigating all this uncertainty. This is where we get into the strategy. Rule number 1, the most important rule above everything else. Do not sell into the panic. History shows us time and time again that market corrections, even the really severe ones, are common, and selling at the bottom is probably the single biggest destroyer of long-term wealth. This quote really reframes the whole situation, doesn't it? A market crash isn't just a crisis, it's a potential bargain sale. It creates a moment where the stocks of fundamentally amazing companies are suddenly available at a huge discount.
So the strategy really unfolds in 4 key steps. First, secure cash. Having 10 to 20% of your portfolio liquid gives you the power and flexibility to act. Second, diversify. Spread your assets around to cushion the blows. Third, and this is crucial, invest in stages. Don't try to time the absolute bottom. Nobody can. Use dollar-cost averaging to buy in gradually. And finally, focus your new investments on those promising long-term themes that are now on sale.
And what are those themes? Well, the source points to areas with really strong structural growth drivers that go way beyond short-term trade spats. Think semiconductors, right? They're the backbone of our entire digital world. Artificial intelligence, the green energy transition, and of course, those stable defensive sectors like pharmaceuticals that provide stuff we need no matter what the economy is doing.
So what does a more defensive, diversified portfolio actually look like in a crisis? Well, take a look here. Notice the big allocations to bonds, gold, and cash. This kind of structure isn't just built for growth, it's built for resilience. It's designed to help you weather the storm without taking those catastrophic portfolio-ending losses.
And we're going to end with this timeless piece of market wisdom. It kind of suggests that these moments of extreme fear and pessimism, just like the one we've walked through, they aren't just an ending. More often than not, they are the very beginning of the next cycle of growth. So the real question is, when you're staring a crisis right in the face, can you see the opportunity?